The market, much like life, moves in cycles. Bull markets roar, bear markets bite, and somewhere in between, the market simply stumbles along. These aren't just phases, they're seasons. And just like you wouldn't wear a swimsuit in winter, you shouldn't invest in sectors that are out of season. This isn't about timing the market, it's about understanding its rhythm. It's about recognizing that what's hot today might be not tomorrow. Imagine the economy as a clock. As the hands move, they highlight different sectors. Sometimes the energy sector is booming, like oil wells gushing profits. Other times technology takes center stage, with innovation driving growth. The market's clock keeps ticking, and the sectors take turns shining. Think of the S&P 500 as a giant pot of stew, simmering with opportunity. Within that stew are different ingredients, 11 to be precise, each representing a sector of the market. You've got your staples like consumer discretionary and healthcare always in demand. Then you have your cyclicals like financials and industrials, rising and falling with the economic tide. Each sector has its own flavor profile, responding differently to economic spices. Understanding the unique characteristics of each sector is like knowing which spices complement each other. Sector rotation is like being a heat-seeking investor, constantly scanning the market for the next hotspot. It's about shifting your investments from sectors that are cooling down to those that are heating up. It's about staying one step ahead, anticipating the market's next move. By analyzing economic indicators and market trends, you can predict which sectors are likely to outperform and position yourself accordingly. It's about recognizing that the market is a dynamic, ever-changing beast. Imagine for a moment, an investor. Let's call him Bob. Bob inherited some money, decided to dabble in the market, heard tech was hot and went all in. Bob, bless his heart, didn't know much about diversification, let alone sector rotation. When the tech bubble burst, Bob wasn't just left holding the bag, he was tripping over it, scrambling to pick up the scraps of his portfolio. This isn't just a cautionary tale, it's a reality for countless investors who fail to grasp the importance of sector rotation. They park their money in a sector, get comfortable, and then wonder why their returns are lagging. Ignoring sector rotation is like ignoring the weather forecast and then getting caught in a downpour. Sector rotation isn't about avoiding risk altogether, it's about managing it, about adapting to the ever-changing market climate. Section 2, Riding the Sector Carousel, from laggard to leader. The beauty of sector rotation is that it's not a zero-sum game. While some sectors might be lagging, others are poised to take the lead. It's like a carousel, there's always another horse ready to take you for a ride. The key is knowing when to hop on and when to hop off. Take the energy sector for example. For years, it was the darling of the market, fueled by rising oil prices and insatiable demand. But as renewable energy gained traction and oil prices fluctuated, the energy sector lost its luster. Meanwhile, the technology sector was quietly gaining momentum. The carousel had turned, and a new leader emerged. Section 3, the Sector Rotation Playbook, no crystal ball required. Now you might be thinking, this all sounds great, but how do I actually sector rotation? Do I need a crystal ball? A team of economists? A direct line to Warren Buffett? The answer, thankfully, is no. While there's no guaranteed formula, there are strategies and indicators that can guide your decisions. One approach is to follow the economic cycle. As the economy expands, sectors like consumer discretionary and industrials tend to perform well. When the economy contracts, defensive sectors like healthcare and utilities often hold up better. By understanding where we are in the economic cycle, you can anticipate which sectors are likely to outperform. Section 4, Risk and Reward, the high-wire act of sector rotation. Sector rotation, like any investment strategy, isn't without its risks. Mistiming the market can lead to missed opportunities or even losses. Rotating too frequently can result in high transaction costs and eat into your returns. It's a delicate dance, a high-wire act that requires careful planning and execution. One of the biggest risks is getting caught up in the hype. When a particular sector is hot, it's easy to get swept up in the excitement and jump in head first. But remember Bob, our tech-obsessed friend? Chasing performance can be a recipe for disaster. It's important to do your due diligence, understand the fundamentals of the sector, and make sure it aligns with your overall investment goals. Remember, the market rewards those who are willing to take calculated risks. The tech boom and bust, a dot-com disaster story. The late 1990s. The air crackled with excitement. The internet, once the domain of nerds and academics, was going mainstream. Everyone, from your grandma to your dog walker, was talking about this thing called the World Wide Web. Investors, blinded by the promise of riches, poured money into anything with a .com after its name. It was the tech sector's time to shine, a full-blown disco party with valuations soaring higher than a disco ball. Companies with no revenue, no profits, and sometimes no real business plan were going public and attracting billions in investment. It was a classic bubble, fueled by speculation and the unshakable belief that this time it was different. This time, the rules of economics didn't apply. As quickly as the tech sector soared, it came crashing down. The dot-com bubble burst in spectacular fashion, wiping out trillions of dollars in market value and leaving investors shell-shocked. Those who had diversified their portfolios, who had rotated out of the overheated tech sector and into more stable areas, were spared the worst of the carnage. They understood that the market, like a disco party, eventually has to end. The financial crisis, when housing went from haven to horror show. Remember the American dream? That white picket fence, that two-car garage, that sense of security that came with owning a home? In the early 2000s, that dream turned into a nightmare. The housing market, once a symbol of stability, morphed into a monster, fueled by subprime mortgages and Wall Street greed. People were buying houses they couldn't afford with loans they didn't understand. The financial sector, which had been riding high on the housing boom, was the first to fall. Banks, saddled with toxic assets, teetered on the brink of collapse. The stock market plunged, erasing trillions in wealth. Investors who had diversified their portfolios, who had reduced their exposure to the over-leveraged financial sector, were better positioned to weather the storm. They understood that no sector, no matter how robust it seems, is immune to economic downturns. The energy roller coaster riding the oil boom and bust. Oil, black gold, the lifeblood of the global economy. For decades, the energy sector, dominated by oil and gas giants, was a sure bet for investors. Demand was insatiable, prices were rising, and profits were gushing like a Texas oil well. But the energy sector, like a roller coaster, is prone to wild swings. What goes up must come down, and when it comes to oil, the descent can be just as dramatic as the ascent. In the mid-2000s, a confluence of factors including increased production, slowing demand, and geopolitical tensions sent oil prices tumbling. The energy sector, caught in the downdraft, went into a tailspin. Companies slashed dividends, laid off workers, and struggled to stay afloat. Renewable energy, once a niche sector, was gaining momentum. Death and taxes, the old adage goes, are the only certainties in life. But there's a third certainty we can add to that list: an aging population. As baby boomers enter their golden years, the demand for healthcare services is skyrocketing. From prescription drugs to medical devices to long-term care facilities, the healthcare sector is experiencing a demographic tailwind that shows no signs of abating. This surge in demand has made healthcare a haven for investors seeking growth and stability. Pharmaceutical giants, with their pipelines of life-saving drugs, have seen their profits soar. Medical device makers are cashing in on the need for innovative treatments. And healthcare REITs, which own and operate healthcare facilities, are benefiting from the increasing demand for senior housing and care. However, for investors seeking long-term growth opportunities, healthcare remains a compelling option. The year 2020 will forever be etched in our memories as the year the world stood still. The COVID-19 pandemic swept across the globe, leaving a trail of economic devastation in its wake. Lockdowns and travel restrictions brought businesses to a grinding halt. The stock market, caught in the maelstrom, experienced its fastest bear market in history, plunging over 30% in a matter of weeks. Amidst the chaos, sector rotation took center stage. Sectors like technology, e-commerce, and healthcare, which benefited from stay-at-home orders and the increased demand for online services and medical supplies, surged in value. Meanwhile, sectors like travel, leisure, and energy, which were decimated by lockdowns and the decline in travel, plummeted. The COVID-19 crash and recovery provided a textbook example of the importance of sector rotation in navigating turbulent markets. Picture this. The economy's been in the dumps. Unemployment's high, growth is sluggish, and everyone's walking around like they lost their best friend. But then, a funny thing happens. A glimmer of hope emerges. Interest rates bottom out, consumers start spending again, and businesses, sensing an opportunity, begin to invest. The early cycle. It's like that first day of spring after a long winter, when the ground thaws, buds appear, and you can almost smell the growth in the air. In this early stage of economic recovery, certain sectors start to bloom. Think of them as the first flowers to poke their heads through the thawing ground. Technology, often a leading indicator, starts to bud as businesses invest in new software, hardware, and infrastructure. Consumer discretionary, sensing a loosening of purse strings, follows close behind as people start buying things they put off during the downturn. Financials too get in on the action. Section 2, Mid-Cycle, the heat is on, growth story continues. The early cycle's optimism, it's blossomed into full-blown confidence. The economy's humming along, jobs are being created, and that little sprout of growth has shot up like a weed. The good kind, the kind that signifies a healthy, robust economy. Welcome to the mid-cycle, folks. The sun's shining, the birds are singing, and the market's putting on a show. In this sweet spot of the economic cycle, the growth story shifts gears. Industrials take center stage as companies, flush with cash and confident in the future, invest in new equipment, expand their operations, and build new factories. Materials, the building blocks of this expansion, follow suit. Demand for steel, concrete, and other raw materials surges as construction projects proliferate. The consumer discretionary sector, not to be outdone, keeps the party going. With jobs plentiful and wages rising, people have more money to spend, and spend they do. Retailers rejoice, restaurants are packed, and the travel and leisure industry enjoys the ride as people finally take those long-delayed vacations. The mid-cycle. It's the economic equivalent of a summer barbecue. Things are hot, the mood is festive, and everyone's invited. Section 3, Late Cycle. The party's winding down, but the drinks are still flowing. The late cycle. It's like that last hour of a party. The music's still loud, people are still dancing, but there's a sense that things are winding down. The economy, while still growing, is showing signs of fatigue. Inflation is creeping up, interest rates are on the rise, and the punch bowl, in this case, easy money, is starting to run dry. In this mature stage of the economic cycle, investors start to shift their attention to sectors that are less sensitive to economic ups and downs. Defensive sectors like consumer staples and utilities come into vogue. These sectors, offering essential goods and services that people need regardless of the economic climate, are like the designated drivers of the market. Not the most exciting, but they'll get you home safe. Healthcare, too, tends to hold its own in the late cycle. As the economy slows and the job market softens, people become more concerned about their health and well-being, leading to increased demand for healthcare services. The late cycle. It's a time for prudence, a time to shift from growth to preservation, a time to trade those tequila shots for a glass of water. Section 4, Recession. Batten down the hatches, it's about to get stormy, the party's over. The music's stopped, the guests have gone home, and the economy's in a recession. It's like a sudden storm on a summer day. One minute you're basking in the sun, the next you're running for cover. Recessions are an inevitable part of the economic cycle, like that hangover after a wild night out. They're painful, they're messy, but they're also a necessary part of the healing process. During a recession, fear and uncertainty grip the markets. Businesses pull back on spending, consumers tighten their belts, and the stock market, reflecting this pessimism, heads south. In this environment, defensive sectors become the heroes of the hour. Utilities, with their steady stream of income from essential services, provide a port in the storm. Consumer staples, offering basic necessities that people continue to buy even during tough times, offer a similar sense of security. Healthcare, too, often weathers the recessionary storm. People still get sick, still need medical care, regardless of the state of the economy. The recession, it's a time to batten down the hatches, to seek shelter in defensive sectors, to ride out the storm until the sun peeks through the clouds again. Now, here's the catch with all this talk of economic cycles and sector rotation. Predicting the future, even for seasoned economists, is like trying to read tea leaves at the bottom of a murky cup. You can look for patterns, you can make educated guesses, but you can never be certain what the future holds. The economy, much like life, is full of surprises. Just because a particular sector typically performs well in a certain economic phase doesn't mean it's guaranteed to do so every time. There are countless variables at play: geopolitical events, technological disruptions, changes in consumer behavior that can throw a wrench in even the most well-crafted economic forecast. So what's an investor to do? The key, as with most things in investing, is to take a balanced approach. Don't bet the farm on any one sector, no matter how promising it seems. Diversify your portfolio across different sectors and asset classes. Stay informed about economic trends and market conditions, but don't obsess over every twist and turn. And remember, sector rotation is a marathon, not a sprint. It's about positioning yourself for long-term success, not chasing short-term gains. Picture a herd of cattle. They stampede, not out of logic or reason but out of blind instinct, following the leader, even if that leader is running straight off a cliff. The stock market, my friend, can be a lot like that. When fear or greed takes hold, investors, even the seasoned pros, can get caught in a herd mentality, buying or selling not based on fundamentals but on the actions of others. Remember the dot-com bubble? Everyone and their brother-in-law was piling into tech stocks, valuations be damned. It was the FOMO trade of the century, fear of missing out. No one wanted to be the last one holding the bag when the music stopped. And then of course it did. The bubble burst, the herd stampeded for the exits, and countless investors were left trampled in the dust. Sector rotation done right is about being a contrarian, about zigging when everyone else zags. It's about tuning out the noise, the hype, the fear-mongering, and making decisions based on logic, not emotion. It's about being the one who walks away from the herd when you see them heading for the cliff. They say the market is driven by two emotions, fear and greed. Fear makes you sell when everyone else is selling, often at the worst possible time. Greed makes you hold on too long, riding a winner all the way down, convinced that the good times will never end. These emotions, powerful as they are, can cloud your judgment, leading you to make irrational decisions that can cost you a fortune. Think about the financial crisis. As the housing market crumbled and banks teetered on the brink, fear gripped the markets. Investors, panicked by the headlines and the plunging stock prices, dumped their holdings, sending the market into a freefall. Those who sold at the bottom, driven by fear, locked in their losses, missing out on the eventual rebound. On the flip side, consider the energy sector during the oil boom. As oil prices soared, greed took hold. Investors, blinded by the promise of easy money, poured money into energy stocks, convinced that the party would last forever. But like all good things, the boom eventually ended, oil prices crashed, and those who had failed to heed the warning signs were left holding the empty barrel. Section 3. When narratives trump numbers, beware the siren song of a good story. Humans are storytelling creatures. We love a good narrative, a compelling reason to justify our beliefs and actions. The problem is, in the market, narratives can be dangerous, especially when they take precedence over cold, hard facts. We get so caught up in the story, the next big thing, the surefire bet, that we ignore the warning signs, the cracks in the facade. Remember the cryptocurrency craze? Bitcoin, Ethereum, Dogecoin. Everyone and their dog had an opinion, a hot tip, a guaranteed path to riches. The narrative was intoxicating: decentralized finance, blockchain technology, sticking it to the man. People poured their life savings into digital assets, convinced they were getting in on the ground floor of a financial revolution. But as with all bubbles, the hype eventually outstripped reality. Valuations soared to unsustainable levels, fueled by speculation and the fear of missing out. And then, the inevitable crash. Those who had bought into the narrative, who had ignored the fundamental lack of intrinsic value, were left holding the bag, their digital fortunes evaporating into thin air. Section 4. Keeping your head when all about you are losing theirs. Navigate market sentiment by staying disciplined and sticking to your plan. Do your homework and understand the fundamentals. Have a plan and stick to it. Don't let fear or greed dictate your decisions. Be a contrarian when necessary. Keep your head and capitalize on the crowd's irrationality. Section 1. The Art of the Pivot Mastering Sector Rotation. We've journeyed through the market's maze, explored its cyclical nature, and witnessed the booms and busts that shape its landscape. Sectors, like actors, take turns in the spotlight, rising and falling with economic tides. Sector rotation is about recognizing shifts, anticipating the next act, and positioning portfolios accordingly. It's a discipline, honed through observation, analysis, and intuition. The market, like a river, is in constant flux. Our strategies must adapt. Mastering sector rotation is about understanding the present and anticipating possibilities. No single sector holds eternal dominance. The balance of power shifts. Think of it as a game of chess, not checkers. Strategize, anticipate moves, and think several steps ahead. Every move has consequences, impacting your ultimate success or failure. Section 2. No shortcuts, no guarantees. The journey of a sector rotation investor. The journey of a sector rotation investor is not for the faint of heart. It's a trek through ever-changing terrain, full of unexpected twists, exhilarating climbs, and occasional stumbles. There are no shortcuts, no guarantees in the market. But for those willing to put in the work, sector rotation offers a path to navigate the market's complexities. The journey is the reward, with the potential to achieve financial freedom and secure your future. Section 3. The final word: keep dancing, the music will change. So, as we reach the end of our exploration, let me leave you with this. The market, like a grand ballroom, is always in motion. The music changes, the tempo shifts, and the dancers must adapt their steps to stay in sync with the rhythm. Sector rotation is about being a nimble dancer, graceful and adaptable, ready to switch partners, to change your style, to embrace the unexpected turns on the dance floor. Don't be afraid to make a mistake, to stumble, to occasionally step on your partner's toes. It's part of the learning process. Pick yourself up, dust yourself off, and get back out there. The music will keep playing, the opportunities will keep coming, and the only way to truly lose is to stop dancing altogether. Keep learning, keep adapting, keep your eyes on the horizon. The market, like life, is a journey, not a destination. Embrace the uncertainty, enjoy the ride, and remember, the best is yet to come.